Well, hello everyone and welcome to Momentum Finance channel. In this video, we're going to take a look at two undervalued real estate dividend stocks that you could consider to watch or possibly even buy in the stock market. So without any further ado, let us get into this video. The first stock for us to review is a company called Douglas Emmett. Douglas Emmett is traded on New York Stock Exchange with ticker symbol DEI, and it is considered to be an office real estate investment trust or REIT. As you notice here, currently this stock pays a dividend yielding 3.43%, and the last trading price for the stock was at $32.64. The company has a market capitalization of $5.74 billion, which is considered to be a mid-cap sized company. Douglas Emmett is a fully integrated, self-administered and self-managed real estate investment trust and one of the largest owners and operators of high-quality office and multifamily properties located in the premier coastal submarkets of LA and Honolulu. Douglas Emmett focuses on owning and acquiring a substantial share of top-tier office properties and premier multifamily communities in neighborhoods that possess significant supply constraints, high-end executive housing, and key lifestyle amenities. The stock has a beta of 0.97, which is considered to be average. Beta is a measure of volatility, and a stock with a beta under 1, below 1 actually suggests that the stock is less volatile than the general stock market. Douglas Emmett DEI current dividend has actually its dividend safety score of 61, which is considered to be safe. All right, let us take a look at the dividend safety and key metrics around this stock. You can see that the company's payout ratio when it comes to the dividends is at 73%, which is considered to be low for real estate investment trusts, allowing them to have room to grow their dividends. They have been paying their dividend without reduction for 11 years. And if you look at their performance during the recession, you notice between 2007 and 2009, they actually ended up cutting their dividend, and not necessarily stopping it, but lowering their dividend. And also when it comes to their sales, their company sales, the business sales was actually down by 11.7%, which is about average growth during the 2007-2009. And in terms of the stock price return, the stock actually almost got hammered. It went down by almost 75% or 74% to be exact, and that actually resulted in trailing S&P 500s when S&P 500 actually went down by about 55% in between 2007 and 2009 during the recession. That's something for the investors to be mindful about. Looking at the annual dividend per share and the details, as we mentioned, you can see in 2008, 2009 or so, they actually declined their dividend. They didn't quite cut it or eliminate their dividend, but they definitely reduced their amount of dividend payment. But they've been paying their dividend uninterrupted for the past 11 years, and 10 years of that, they've actually year after year grown their dividend. Looking at it, you can see it was just under half a cent per share back in 2010, and right now it's over $1 per share in terms of the dividend per year. As you can see, to be exact, the annual payout is $1.12, and their dividend is paid quarterly in the month of January, April, July, and October. All right, let us take a look at the valuation metrics. And Douglas Emmett's current dividend yield of 3.43% is 32% above its 5-year average of 2.6%, which indicates the stock may be undervalued unless you believe that the company's outlook has weakened. What's more, we are going to take a look at their price to adjusted funds from operations as another ratio which is important for real estate investment trusts. For those of you who are not familiar, adjusted funds from operations, or AFFO, refers to the financial performance measure primarily used in the analysis of real estate investment trusts. The AFFO is actually obviously subject to some varying methods of computation, but is generally equal to the trust fund from operations, FFO, with adjustments made for recurring capital expenditures used to maintain the quality of the REIT's underlying assets. And in this case, the forward price to adjusted funds from operations ratio is at 2.3, which is below their 5-year average of 22.3. In other words, the stock looks cheap compared to how the market has valued it in the recent years. Looking at the price range for the stock, The last pricing of $32.64 is in between, hovering a little bit closer to the 52-week high. The 52-week high price for the stock was at $36.77, and the lowest price in the past 1 year has been at $23.25. And if we compare the price to adjusted fund from operations for Douglas Emmett, which is at 20.3, to that of the overall real estate, it is lower than the real estate sector as a whole. For the real estate, the P to AFFO ratio is at 20.5. Looking at the number of outstanding shares for this REIT, you'd see here that there are currently showing the last 12 months 175 million shares, outstanding shares. Ideally, we'd like to see this number gradually declining, but in this case, it seems that it's gradually increasing. They're issuing more shares. Not the biggest red flag, but definitely something to be mindful of. In terms of the total sales, though, look at that. For the most part, they've been managing to increase their sales year after year for the past 10 years. Though from 2019 afterwards, they have been following almost like a declining trend. And the last 12 months is showing to be $870 million in total sales, which is higher than 2017 and any year prior to that in the past 10 years, but it's definitely lower than that of 2018, 2019, or that of 2020. In terms of the stock price return, we have two graphs. The graph on the right side, it shows you the trend over the past 1 year. The past 1 year, the stock price has gone up by 22% plus, but in the past 5 years, the stock is showing to have gone down by 13.61%. Does provide opportunity if you think that the stock price will be able to reflect their growth over time, increasing in sales gradually, and given the fact that the stock appears to also be undervalued, given based on different metrics such as the price to adjusted funds from operations that we looked at it a while ago. Looking at the price prediction and price forecast by analysts, we are looking at two sets of analysts. One is from TipRanks. Here we have 7 analysts covering the stock. 5 of them have a hold rating for the stock and 2 have a buy rating. In total, that leaves us with a moderate buy, and the average stock price in 12 months or 1 year based on analyst estimates would be at $37.57, and if that holds true, that shows an upside of 15% plus at this time. Also, the highest price target by analysts is at $42 and the lowest is at $34. We're also taking a look at the analysts by Simply Wall Street. Here, we are showing an upside of 19.4%. In other words, according to current price compared to the fair valuation, according to analysts of Simply Wall Street, the stock is about 19 to 20% undervalued at this time. All right, before we move on and continue with the stock, the second pick that we have here, I have a request for you. I appreciate if you actually be sure to subscribe to Momentum Finance channel. Here on Momentum Finance, we post every week several videos about investing in the stock market and analyzing stocks and reaching financial freedom. And we really appreciate if you can give this video a thumbs up and subscribe to our channel. Thank you. All right, the next stock, the second pick that we have for you in terms of quality undervalued real estate stocks is no other than Universal Health Realty Income Trust. It is a healthcare REIT with ticker symbol UHT, traded on New York Stock Exchange. It also has a dividend safety level of safe with a score of 65. When it comes to dividend yield, UHT does pay a higher dividend compared to the previous picks that we have. Actually, its dividend yield is at 4.88%. And this stock is considered to be small cap. It has a market capitalization of $794 million. From a beta or volatility perspective, UHT has a beta of 1.17, which is considered to be high. In other words, higher than the general stock market when it comes to the stock volatility. Universal Health Realty Income Trust is a real estate investment trust investing in healthcare and human service related facilities, including acute care hospitals, rehabilitation hospitals, subacute care facilities, medical office buildings, freestanding emergency departments, and child care centers. And they have investments in 71 properties located in 20 states, including 2 that are currently under construction. All right. Let us take a look at some key metrics from a dividends perspective. Their payout ratio is at 78%, which again is considered to be low for medical building REITs. They have been paying their dividend uninterrupted for the past 35 years, which is remarkable. During the recession of 2007-2009, they increased their dividend payment. Again, remarkable. Their recession sales went down by only about 12.7%, which is considered to be above the growth that we saw overall between 2007 and 2009 for companies as a whole. And in terms of the comparison to the performance of S&P 500 during the recession time, their stock price went only down by about 29%, which is way better than that of 55% for the overall S&P 500. Looking at the annual dividend per share, you'd see how they gradually increased their dividends year over year. In fact, for the past 35 years, not only they have paid dividend uninterrupted, but they've also year after year increased their dividend payments. UHG does pay its dividend quarterly as well in the month of March, June, September, and December, and they currently pay an annual dividend amount of $2.80 per share. Looking at the valuation, the forward price to adjusted funds from operation was not available here based on our analysis and the data that point that we've recovered and found. But looking at the data from 𝗖𝐋𝐈𝖖𝐊, they have the funds from operations trading 12 months, and for that they were showing 3.56 as the number there that we could refer to. And the UHG's current dividend yield of 4.88 is about 25% above its 5-year average of 3.90%, which indicates that the stock may be undervalued unless you believe that the company's outlook has weakened. You'd notice here the stock price is definitely hovering a lot closer to that of its 52-week low price. The highest price that they have hit in the past 1 year was at $74.68. A lot of room to grow if the stock was to recover and get back to where it has been in the past 1 year time frame. With that, there's no surprise that if you look at the past 1 year stock price return, it is actually showing to be down by about close to 10%. You'd see here how closer to March or April they had hit some of the highest price in the past 1 year. And if you look at the past 5-year stock price return, almost similar to in the past 1 year, it's still showing close to 9.84% down. In other words, had you bought the stock in the past 1 year, probably it would have been similar return to had you bought it in the past 5 years. This is solely from the stock price return. We're not looking into the actual dividend. Obviously, owning this stock, and given the fact that they've been paying their dividend uninterrupted and increasing it for the past 35 years, you've been collecting that solid dividend income from this stock. In terms of their outstanding shares, they are showing 13.8 million outstanding shares, which is somewhat similar to the past 2 years. It's showing definitely some increase, not definitely ideal, but it's not drastic increases compared to the previous years. In terms of the total sales, though, they are showing some gradual increases. In fact, the last 12 months is the highest amount of total sales compared to the past 10 years. It's showing to be at $83 million in total sales when we compare that last 12 months sales to that of the previous years. All right, let us take a look at the analyst stock kind of estimates and the target for the stock price. We did not find any stock price done by analysts on TipRanks, and even if you looked at the Yahoo Finance, they do not have a target price for this stock for UHG. However, for Simply Wall Street, they are comparing the current price of the stock to that of its fair value. According to them, the fair valuation for the stock is at $91.93, and if that is true, that it shows that the stock is down or undervalued by close to 38%. Well, there you have it, folks. A quick look and review into undervalued stocks in real estate sector that you might consider to add to your watch list or potentially even buy, subject to further research and analysis by yourself. Please be sure to do your own research though before buying into these stocks that we talked about in here or any other stock for that matter. And we've done our research. Nonetheless, this is not a financial advice, and you've got to do your own research and make sure you do your own due diligence before you buy any stock or equity that you hear about here on our channel or any other channel on YouTube for that matter. With that, thank you so much for watching this video. I hope this video was beneficial and hopefully introduced you to two companies that probably are not as much talked about, yet they could provide potential good opportunities for investors out there. If you found this video beneficial, I really appreciate if you can give this video a thumbs up. And of course, don't forget to subscribe to our channel. Here on Momentum Finance, we post every week or every other few days videos about investing in the stock market and ways to reach financial freedom. Thank you, and we hope to see you next time.